Okay, so Palantir just dropped an earnings report that has everyone talking. The numbers are huge, the claims are even bigger, and the market is definitely paying attention. But let's be real, what's actually going on behind all those headlines? Well, that's what we're here to do. Today, we're putting on our detective hats, opening up the case file, and digging through all the evidence to figure out what's real, what's just hype, and what you really need to know. All right, let's just start right here with this absolute bombshell of a quote from the CEO, Alex Karp. I mean, get this. He's not just saying, hey, we had a pretty good quarter. No, he's basically claiming it's one of the best quarters a software company has ever had. That is a wild claim, right? And it sets up our whole investigation. Is he justifiably confident, or is this all part of a carefully crafted story? Let's look at the evidence. So, here's our first clue. The number 114. Now, I know what you're thinking. 114. What on earth does that even mean? On its own, it's nothing. But in the world of software companies, a number like this is kind of like the smoking gun. This is Palantir's score on something called the Rule of 40, and it's Exhibit A in this entire case. So what the heck is this Rule of 40 anyway? Well, think of it as a super quick health check for a software business. It's pretty simple. You just take the company's revenue growth rate and you add its profit margin. If the answer is more than 40%, you're looking at a healthy company. The car analogy is perfect here. You want speed, that's your growth, but you also want fuel efficiency, that's your profit. For Palantir, they took their 63% growth, added their 51% adjusted profit margin, and that gets you to 114. That's not just breaking the rule, it's shattering it. It's practically unheard of. Okay, so a score of 114, that's pretty compelling, you have to admit. But, any good detective knows you can't just close the case based on one piece of evidence, no matter how shiny it is. We have to dig deeper. We've got to ask, what's really driving this number? And more importantly, what could it be hiding? So let's properly open this case file and see what else we find. All right, first step in our investigation, we're going to do what any good detective does. Follow the money. Where is all this crazy growth coming from? A company doesn't just trip and fall into a number this big. Something under the hood is firing on all cylinders, and it's our job to figure out what it is. And wow, this chart really tells you pretty much everything you need to know. The company's total revenue grew 63% compared to last year. That's awesome on its own. Their bread-and-butter government business grew a super healthy 52%. But look at this. The U.S. commercial business, it just went nuclear. 121% growth. That's not just an engine in overdrive, that's an explosion. So, what's causing this fire? Well, if you listen to Palantir's management, it's one thing and one thing only: their artificial intelligence platform, or AIP. They literally use the word insatiable to describe the demand. The story they're spinning is that every company out there is scrambling to get on the AI train or risk getting left behind, and Palantir's platform is something they just have to have. And look, they've got the receipts to back it up. $2.8 billion. That's how much new business they signed in just 3 months. It's a company record, and it's up 151% from last year. And this isn't just a flash in the pan. We're talking about locking in huge, long-term deals. But here's what's really, really interesting. This wasn't just them winning the lottery with one giant deal. Nope, we're talking about more than 200 different deals worth over $1 million each, and almost a quarter of those were for more than $10 million. So this suggests the demand is wide and it's deep. It's not just one or two big wins. It looks like that growth engine is legit. Okay, the growth story is solid, no doubt about it. The money trail is pretty clear. But remember our car analogy? A super fast car that's just leaking oil everywhere isn't going to win the race. So the big question now is, are they actually making any money from all this, or are they just burning cash to grow so fast? And this is where things get a little tricky for our investigation. When you look at the books, there are two different ways they're measuring profit. There's the official accounting number called GAAP net income, which was $476 million. And then there's the number the company really wants you to look at, adjusted free cash flow at $540 million. They're both big, positive numbers, which is great, but they're different. And as investigators, we need to know why. So what's the big adjustment? Well, for the most part, it comes down to one thing: stock-based compensation. It's basically paying your people with company stock instead of cash. It's super common in the tech world, right? It's a great way to hire top talent without draining the bank account. The catch is, while it's not a cash expense on paper, it does mean there are more shares out there, which can water down the value for everybody else. Companies love to show you this adjusted number because it makes the core business look like a pure cash-generating machine. And once you make that adjustment, you get this, a 51% adjusted operating margin. Remember that fuel efficiency we talked about? This is it. This is the other half of that rule of 40. So you take that crazy profitable 51% margin, add it to the 63% growth, and bingo. That's how you get to that bonkers score of 114. Okay, let's recap. The story from the earnings call is almost too good to be true, isn't it? Insane growth, incredible profits, looks like an open and shut case. But wait a second, we're not done yet. Every good detective knows you have to read the fine print. And for us, that means digging into the official legal filing, the 10Q. Think of the 10Q as the exact opposite of that flashy earnings call. This is where the lawyers get to say, okay, here's all the stuff that could absolutely wreck us. There's no hype, no marketing spin, just the cold, hard potential risks. So let's get our magnifying glass out and see what we can find hidden in these pages. And boom, here's our first clue. It's the classic all your eggs in one basket problem. Turns out a single customer, they don't even name them, accounted for over a fifth of all the money that Palantir was owed. I mean, think about that. If that one relationship goes south or that customer has a bad quarter, that is a huge, huge problem. It's a major risk factor you just don't hear about on the earnings call. Okay, clue number 2. Remember that incredible $2.8 billion in new deals we talked about? Well, this kind of throws a little cold water on that excitement. The company flat out admits in the filing that it can take a really, really long time to actually close these massive deals. We're talking 6, 9, sometimes even a year or more. What that means is that growth isn't a smooth line up. It can be lumpy and unpredictable. And trust me, it doesn't stop there. The 10Q is full of this stuff. They talk about how hard it is to hire the best engineers. They mention how their government contracts can basically be canceled at any time for any reason. And, the usual stuff about a bad economy hurting business. It's basically a long list of everything that keeps the executives up at night. But honestly, of all the things in the fine print, this one might be the most important. It's the warning label, the one you find on the side of the box. After all that hype from the CEO, the company's own lawyers are legally required to tell you, hey, don't bet the farm on this. Past performance is no guarantee of future results. It's a huge reality check. All right, let's head to the deliberation room. We've examined the evidence from both sides. We've heard the exciting, optimistic story from the earnings call, and we've read the cautious, lawyer-approved version from the official filings. It's time to put it all together. So, on one side you have the bull case, and man, is it strong. You just can't argue with that 121% commercial growth. The demand for their AI platform seems totally real, the contracts are huge, and that rule of 40 score is just stunning. But then you look at the other side of the coin. The bear case is also pretty convincing. Relying so much on one customer, that's risky. The fact that sales can be so unpredictable, that's a real concern. So where does that leave us? What's the final verdict? Well, the truth is, this is one of those cases where both sides are right. Did Palantir have an absolutely unbelievable, maybe even historic quarter? Yes, no question. But does the company also face some very real, very serious risks that could stop this train in its tracks? Also yes. Our job as investigators was to lay out all the evidence for you, the good, the bad, and the fine print. We've put the entire case file on the table, but now it's up to you to be the jury. After seeing everything, what's your verdict?